disclaimer out there for you guys. There we go. There is a very high degree of risk involved in trading. You and you alone are responsible for the decisions that you make, whether you're following someone or taking the lead. You must assess risk of any trade and make the decision for yourself. Past performance is not necessarily indicative of future results. And let's go ahead and see if we can figure out the next step here, which would be the opinion. We're looking for Tom's opinion of the market today. Although, I need to hit that slide one more time. All right, Tom, what's your opinion today?
Hey, how you doing? Uh, Jonathan, did you make sure Jeff Hirsch was able to get signed on?
Yes, Jeffrey is here and we welcome him in.
Well,
I'm
hello,
here.
hello. All right, well, let's talk about the market a little bit. And one of the things that is sort of interesting, I think that the market often reacts to what they perceive as bad news or good news, and the market itself is really, I see it I see it very strong, other than the fact that it's very weak this morning. But that's the way the winds blows. You just got to be loose and ready to go. But if you stand back and look at it, and I'm really looking forward to hear what Jeffrey's got to say. But I want to show you a couple things. One of the things that we're doing at DTI, and I shared some of this with Jeffrey, is and let me just ask everybody, how many people are using the 3-day algo each month that we give you? Let me ask the customers that. Hello, John Marie. Tried to say it right. Hey, Carrie. But anyway, I was showing it to him, and I was telling him the background of it was the fact that uh, there's a lot of great stuff inside the Trader's Almanac that I've used over the years. And this is one thing I think sort of is a grandchild of the Santa Claus rally and the January 1st 5 days. But I got onto this years ago, and if you test it out, it's pretty strong. But if you look here, right now here in the month, it's got crude and it's got gold and silver and bonds and TLT, which is a derivative of bonds, positive. And if you look down at some of the stocks that we got, see what we got down further. They've got XBI. We made a lot of money on that one. AGQ, I don't trade it anymore, but AGQ has been a very good stock over the years, but I like to use it as an indicator for trading silver or silver futures. SLV's along. Speaking of that, how many people would like to learn what I call the wheel trade, the silver wheel trade? Let me ask that question. Okay, I'm going to announce. I probably can't do it today. Maybe next week I'll get into it and teach you a silver wheel trade I think you'll really like. It rolls along, right? And but if you look at silver right here, it's gold. Everything's very bullish. We've been long, a long time. And what they got short there? I'm just looking what short. Apple's short. I talked to one of our big customers yesterday, and he's a lover of Apple. And I was telling him, I think really what's going on there is Tim Cook might be putting one foot out the door, and they haven't named a successor and that kind of stuff. Maybe there's a little uncertainty there. I don't know. It's just my thoughts after following Apple all these years. And that's just an opinion. I got Meta short, Microsoft short. I've got Google long. I've got MU. How about MU? Now, Micron is a stock. I actually traded it overnight. I hadn't checked it. It looks like it's doing pretty good, I think. But I like to trade the overnight stocks that are set up. You got JP Morgan short. You got Goldman Sachs long. Now, my NNE, I've been long nuclear for a long time. It's finally showing something. And look, Neil made 2,000 last night on MU. You read the notes, huh? Way to go. If you listen and learn, I believe in education, and look, let me tell you my opinion. I've been doing this for so many years. Nobody's got a lock on all the knowledge, but you pick up knowledge from people that have passion and people that have been doing it a long time. And that's why I'm really excited to have Jeffrey here today. I really respect him and his father, with the Trader's Almanac. I've got a copy of it. I keep it with me because it's like a memory jogger for me. And I just go through it week by week and day by day. So that's a real big plug that I don't give to everybody. I'd give it to him and what he's put together. And we've been talking a little bit about futures, and I told him I'd really like to help him do it if he does it. So now this is what I posted last night in Futures Plus in the Education Telegram channel. Now, last night I was talking about ME, and I said the low is 82. The risk reward is good. If the market turns back below 68.75, it's not a good trade. But I said it should target 707. Jonathan, did we go right to 707 overnight? We did. There it is. Look at that. How about that, folks? Roadmap software, nothing like it in the world. Took us right to 707. These numbers are pretty good. It was developed for futures years ago. I use it for stock and stock options now, but that's pretty good work overnight, I think. Notice our RB1, our reference bar, it got positive after 9 o'clock. Asia and Europe did their thing, and off we went. Now, that's pretty cool to be able to do it. Next, you got the metrics. Look at the metrics, what it laid out. RB1 opened at 86. It said the week opened at 7,007, which told me it would be resistance. And the month opened 69.02. As long as I'm above the monthly open, you know how I do it. I keep it simple. I'm bullish. It said buy at 93 on the S&P, which was the time I made this post. And I wanted you to see it. Told you to review our training video. And then, I also posted something. I was talking to one of our great customers about if you're not ahead, get out and go to bed. That's don't try to stay up all night. That's a pretty good little saying. If you're not ahead, get out and go to bed. But I want to show that to you. You got to use that roadmap software if you really, really want to be successful, in my opinion. We've got a lot of work in it, has it all, and it's right there in the Compass page. And Jonathan captured it out the posting in our Futures Plus. We'll be talking about Futures Plus Sunday night. All right. Let's look at the 30-minute chart of silver futures. This is important. I've been trading a lot of silver and SLV. That's what I was talking about. Silver has got a RB high, 89.33. The week opens 80.50. This is silver futures I'm talking about. 5-day low, 79.94. And the week low is 79.94. And silver futures right now, let me check it real quick. It's 88. We're well above those numbers. 10-day low, 72. Month open, 71. So you really got a market that is strong, but it breathes. No market goes straight up. And, you got to remember with silver and gold, especially, they have what I call air pockets. And when you have one of these, it's just getting ready, I think, to churn and go higher. Got to be patient sometimes. But I want to show that to you, those numbers sort of outline the way I see the silver market. Now, I am excited to introduce our special guest today, Jeffrey Hirsch. Jeffrey, I'll tell you, we did a poll after you spoke last time, and people were off the charts. They begged me to bring you back. So not being one to disappoint my customers, I said I'll talk to him and I'll beg Jeffrey to come back. This is a busy guy, folks, but I'm going to tell you something. Very knowledgeable when it comes to the stock market, and I can't wait to hear what he says. This time of year, this is like getting the Trader's Almanac interactive, like our interactive home study. Take it away, Jeffrey.
All right, thanks, Tom. Appreciate everybody's appreciation and request for having me back. Let me see if I can just do the technical stuff here and get my deck up. So bear with me as I do the share. Let's see. Replace current share, I guess.
That's great. Thank you.
Yeah.
That'll work.
How's that looking?
Looks great.
All right. Uh-oh. Okay. Listen, I appreciate you guys having me back. Tom's great. We've been having some great chats. I really like looking at the 3-day algo. His data, I'm still digesting it. I think there's more to do there. I love how it works, with overlays of different periods there. Really dovetails well with my January indicator trifecta, which is combination of the Santa Claus rally and first 5 days and the full month January barometer. Of course, to my father for putting those together, for creating those. So I know there's a lot of people that are here from last time, but I'm just going to run through a couple things for those that may not be familiar. And then I'm going to go over some of the things I mentioned last time and update my full forecast. And I got a couple little sector commodity trades at the end. So, I mean, we've been around for 60 years. As Tom says, he's got his Stock Traders Almanac at his side. Here it is right there. All of our subscribers get one for the newsletter. Is some of the other books. I'm gonna touch on the super boom a little bit today. The AI super boom, which I think will be driving this market higher for years to come, notwithstanding some pullbacks and probably a cyclical bear at some point, not necessarily on the near horizon, but we will get a bear market. I think the secular bull goes on. Been on around for almost 60 years now. I will be 60 this year, for those of you that are wanting to do some of your birthday shopping early. But it's a big year for us in the Almanac. For me, we've been on the street since 1968, when the first edition came out in 67. My father started this in 66, the business, the year I was born. Sold over 1.5 million copies. It's arguably one of the most influential books on Wall Street. I mean, if it's on Tom's desk, it's definitely got some influence there. Santa Claus Rally January Barometer, invented by Yale, best 6 months, not just sell in May and go away. You got to buy in October and get your portfolio sober. As I like to say, I went through that last time. I'm not going to bring that up again. We can get into that at another time in the future, maybe when we get in April. Santa Claus Rally failed to call this year. Not to be so concerned. It's May. Bears may come to Broad and Wall. You can see the May right there. It's not the have all the end all, but look at the trifecta indicators and where we're at. Again, like the Santana quote, you got to remember the past, but I think that those who understand market history are bound to profit from it. Again, we've been putting all this together for 60 years, constructed portfolios, put it all in the Almanac and the newsletter, using a combination of technicals, of fundamentals, seasonals, and internals, and what's going on in the world. If you want to sign up and get the Almanac for free, if you didn't already, I appreciate a bunch of people last time coming up. Here's the same deal. Just want to make sure it's available for everybody. You can either scan that and just or go to the website and use the code with the 1 year or 2 year use DTI. Pretty simple. But today, 25 delivered on that bullish post-election year pattern forecast that I made. We'll look at the case for another bullish year here. Not quite as strong as last year with that 6th year of the presidency. A lot of people are worried about the midterm year, but this is the second midterm year. It's more bullish. Economy solid. I got some fundamental numbers in there. The trifecta we'll look at. The sweet spot, the AI boom, a little January Barometer 101, why it works, and a look at the Almanac for the month of January. Just a quick run in there to see some of the difference in January and all years versus midterm years. And I got a little peek at a couple of sector commodity trades. And then for all the other stuff, you got to jump into the newsletter. So last year, 25 here in the red line. Yeah, we had the tariff tumble, but we were commenting way back in the Almanac. I mean, I wrote that initial outlook back in May of 2024 for 25, way early. The Almanac gives us the ability to look out into the future. This green bullish line here, post-election years since 85, been much stronger than all post-election years, which are down here in the single digits. And again, our aggregate cycle, which appears on a lot of these charts, is a combination of the seasonal pattern for all years, the year of the 4-year cycle, and the year of the decade, the 5th year in this case. For 26, this is right out of the newsletter. Started out with our outlook. I know, Tom, if you look at the outlook on pages 10 and 11 of the Almanac, I was a bit more concerned mid-year, around just ahead of Memorial Day when I put this out. The outlook in the Almanac that wasn't quite next year, which we're in now, the 26th, was going to be a little more difficult because it was a midterm year. We still hadn't cleared those resistance levels off of the tariff tumble. And my forecast that came out in the newsletter back in early December, about a month ago, was significantly more bullish than what's written in the Almanac. So right now we're looking at the 6th year of the presidency and the AI boom really fueling the bull. I give a 70% probability to gains in the 8 to 12% range for S&P, and maybe a little bit more for NASDAQ. Dow seems to be coming around. Russell looks pretty solid right now here too, with the rates going down. Expect a little volatility. We've seen some of that. I think we'll get more of it in Q2 and Q3, and then that Q4 rally, which is that sweet spot of the 4-year cycle, the beginning of it, the 3-quarter combo, and the boom continues. I've updated the boom. It's in there in the outlook, and I'll get into that in a little bit. But all things go well, 10% probability. All the policies from the Trump administration just accelerate the economy. Things just sort of blow out, and the Fed is successful in cooling inflation even further. Though I think the inflation numbers that they put out that they expect to get down to 2%, I think that's pie in the sky. Average inflation from my research is about 3%. Got to get some labor market issues, but basically, the president cements his legacy and his party retains control of Congress, which is a stretch. There's some razor-thin margins there, and incumbent administrations, parties generally lose House seats and Congress seats. So if they can pull that off, that would be best case scenario. Worst case, everything hits the fan. Old school, ugly, volatile midterm year, bear market, teetering on recession, negative flat year performance. I give that about a 20% probability. So not off the, out of the question, but definitely not high probability. So looking at some of the fundamental numbers, Atlanta Fed yesterday or 2 days ago put out a forecast for about 5.3% on the 14th for Q4 on top of Q2 and Q3. You can see here pretty strong, solid, robust economic numbers. This is part of the equation, part of what has got us supporting the bullish case on top of the 6th year and the AI boom and the Fed easing. Here's the unemployment. The one that we like to look at is initial claims, less manipulated, especially with the shutdown, giving us some rough numbers, some dubious numbers. But if you can look here, you see this spike of initial claims, a little concerning, but it's the same pattern that we get seasonally at the beginning of every year. So this is typical. As long as there's something we got to keep an eye on, as long as this doesn't get too risky or get too elevated and retreats as it does normally this time of year, I think we're okay with the labor market, but we're keeping an eye on it. Inflation rising a bit. Again, you see this gap right here between the shutdown data. I'm not so sure CPI has come down as much as the last readings have. We're going to have to wait on this and get some more readings, but it has been ticking up since the latter part of last year. Again, watching that there. Interest rates, kind of a state of confusion. This is from yesterday. You can see sideways on the 10-year in the bottom, and then the top line is the 30-year. Again, starting to go sideways here. To us, this means we're probably not getting any cuts. This is the probability for a cut at the end of January. Not going to happen. I suspect we're not going to get anything, another quarter point until June. I think the market's okay with that. Economy's robust, labor market's steady. The boom is back. We got small caps rallying. We got the Dow rallying. We got the Mag 7 picking up again. All the stocks that Tom was talking about. So really no need for a cut. But new Fed chair will come in May. And I think that may be the time that we'll get a little back into the easing cycle, which we remain in. And then sentiment. I look at the Investors Intelligence numbers. That's been around for a long time. They survey guys like Tom and myself that get paid for their opinions, not just the AAII survey, which is just retail brokers or retail investors telling somebody what they think is going to happen. This is people who are putting out recommendations to paid members, paid subscribers. And what I've highlighted here, the difference between bull and bears has gotten elevated into that sort of concern area here. Happened last October. We got a little correction there. It's above 40% where you've got, the difference between the bullish percent and bearish percent at 40. Bulls are almost at 60. Bears are under 20. But if you look back in the last, a year or so ago, you can see that we had this elevated in the yellow there, elevated, bullish complacency, yet the market continued to rally through 24, before we had that pullback there at the tariff tumble. So again, that's the sort of combination of some of the different disciplines we look at: fundamentals, technicals, interest rates, and sentiment, in addition to the seasonal work that we're doing here. So the second midterm year is all about cementing the legacy. We've got I've got this chart that I updated from what was in the almanac I took out. And if you look there on page 10, I had the Second Republic. I had the fifth, it's the 6th year. I had Republican midterm years. We just got the second years in here. We sort of focused on these more bullish outlooks, these more bullish seasonal patterns from the 4-year cycle. The aggregate cycle, again, is midterm years here in the black line combined with all years. And the 6th year, I don't give a whole lot of credence to the decennial cycle as much as the 4-year cycle, but the middle of the decade seems to be strong. And if you remember back in 2000, we had the 0 years being weak. So all midterm years down in the blue line in that lower, that was what my initial outlook was looking at, more in the 4 to 8%. Considering the reset that we had back in April, which was sort of a quasi bear market, not an official one, kind of helps reset the market here. And maybe we're in a sort of a new leg of a bull, or giving it new fuel here. And I think that's what, adds some more support to the bullish case for that 8 to 12%. Coming right out of here. You can see the aggregate cycle and the 6th year. So that's kind of the range we're looking at. Just to, keep us honest, the 4-year cycle, midterm year, historically the weakest year, the 3rd year, the pre-election year, the strongest year where presidents prime the pump to keep their party in power, or themselves if they're running for re-election. And this sets up that sweet spot of the 4-year cycle. NASDAQ up 30% in the pre-election year. That was 23. It's encouraging, but you got to watch out for the setup here. But looking more, drilling down a little bit, I think I shared this chart with you last time. This weak spot, which is where I think we're going to get some volatility and weakness this year, Q2 and Q3 of the midterm year, NASDAQ off average 6%, going back to 71, Dow and S&P 2.5%. But this 3/4 sweet spot is where we set up that trade, sort of back up the truck in October. If we get that midterm, remember October 22, we had a very classic October midterm year bear market bottom. I don't suspect the bears this year, but I do think we'll get some sideways and set up that Q4 through midterm year through Q2, the pre-election year sweet spot. NASDAQ almost 30% over the 3/4, S&P and Dow around 20. And this is what sets up, another Yaleism, the 50% gain from the midterm low to the pre-election year high. Dow is actually 46.6. NASDAQ, and granted, these are all up, it never misses when you go from the low to the high. It is set up that way. NASDAQ is 66% from the midterm low to the pre-election year high. That would be the low in 26 versus the high in 27. I guess the thing that stands out most for me here is the December and the last trading day of the year for the pre-election year, where most of these highs, or a good number of these highs, are made in December, and a lot of them on the last trading day of the year. So, in addition to the sweet spot, the 3/4 to Q2, the whole year is pretty powerful, and a lot of times you get those highs at the latter part of the year. Here's a look at the 4-year cycle, the tracking of it, all the years together. I've got this updated through when we put out our forecast for Dow, S&P, and NASDAQ for 25. You can see we pulled back just a tad at the end of the year, but again, tracking this pattern, the tariff tumble was more extreme, but it does line up for that weak first quarter, period of the post-election year. Again, all midterm years kind of flat. I think we might end up being a little bit higher than the average, but again, not as strong as the previous couple of years. Not necessarily in the 20% range, or 15 to 20, more in the around 10 or so. And here's that sweet spot. You can see it on the chart beautifully. Get a little bit higher at year end, but you got the weak months here. The sort of selenite period, Q2, Q3. So long term, this is a chart I'm not sure if you guys have seen recently. This is a subject of my book, Super Boom, which you saw, which is a pattern that Yale discovered back in 1976. It's a secular market pattern. You can see these secular bear markets highlighted in the gray shades, the sideways period, like we had after 9/11 through 2011. And right after this big drop here in the GFC in 09, the following year we felt we were repeating this pattern. We put out that forecast in May of 2010 for this 500% move to follow the war and inflation, and like Yale discovered back from World War II and one and Vietnam. However, the inflation, we didn't have the same spending that we had during the 3 prior major military involvements. But what happened a couple of years later, a few years later, was COVID. And if you think about some of the government spending that we had, the massive, what was the name? I can't even think of the name. The big acts. I mean, the trillions of dollars that were put out there, very similar to the kind of spend that we had in the 3 major wars of the 20th century there. So that sort of kicked in that inflation, and we had not had the CPI up, but now it was up quite a bit. And then there's this culturally enabling paradigm shifting technology aspect, and the AI boom I find very similar to previous technological disruptions, going all the way back to like fire, the wheel, indoor plumbing, combustion engine, refrigeration, microprocessor, air travel, all that kind of stuff that really changed the world. It's the kind of thing, and I don't know if you guys are sensing it, but I'm feeling it. It's changing my life individually and the whole world collectively, and that's what keeps the super boom going. And I think we're at the relative early stages of that, kind of like, feels like Windows 95 era, when I was converting all of the calculations we did for the Almanac by hand. At first, I moved it over to Excel for DOS, and then early mid 90s we went into Windows 95. There was Windows 3.1, I remember, and then and it just sort of changed everything. And that's where we had those runs of many years in a row. It was about 5 in a row in the 90s where the market was just up almost 20% a year. I think we're at a similar period right now. So with all that said, we've got the January indicators along the lines of the 3-day algo. Again, invented these back in 73, and then at 72 was when it came out, the 73 Almanac. You can see January barometer, Santa Claus rally. The first 5 days is something that's been around for a long time. And basically, it's not a binary sell signal. We just updated this in the newsletter for subscribers, talking about how to use the January barometer and the January indicator trifecta. It's not a sell signal or a buy signal. It's a warning sign or a confirmation sign to look at your other indications and whatever else your other analysis for the market is. For us, I just went through a bunch of that midterm year, AI, uh, tech boom, and the economics, the great growth that we're seeing, and interest rates being low. Um, Here's just a look at the Santa Claus rally. This is the page out of the almanac. This is what, page 118. Yeah, and just a look at the recent history of Santa Claus failing to call. 25, we know the market was up 16. The S&P was up 16.4%. We had a near bear April tariff tumble. 24, Santa was down, 23% gain, AI super boom. Had a little bit of a mini bear in 2016, if you remember that sort of February low. And then we had a flat year, a couple flat years, 3 flat years, 2000, 2008. So it's a warning sign. It's not, a trade. It's an indicator. I think that's how Tom's using that 3-day algo, is to give you an indication as to what to buy, individual stocks and sectors, and what it means. It's not just a trade. It's not a trade. It's an indicator. So here's a chart that we put, sort of a different version of this comparing the monthly barometers. That the January barometer gets a lot of flack, and every year, if it's up or down, people start talking about the market being up 70% of the time anyway, even though it's up more when the January barometer is positive. But you can see this is just the S&P. In the issue, we've got the same chart for NASDAQ and Dow. Going back to 38, there's one more major error. It was 1946. There's a 75% accuracy ratio, including, I think it's 9 flat year errors. So the reason it works is really the lame duck amendment to the Constitution, the 1933 amendment that had newly elected members of Congress taking office in the January right after they were elected in November versus 13 months later in December. That's why they're called lame ducks. Back in the old days, it took quite a while to get to Washington, and then it also moved Inauguration Day to January 20th from March 4th. You've got, forecasts, outlooks, agendas being set. We used to get the State of the Union in January, but now, we don't quite get that as much. They're taking a lot of time, but we are getting policy agendas and initiatives from both the White House and Congress. We're seeing what's going on there. It's playing out for us right now with the new Congress and the president making a lot of, talking about his budget, what he wants to spend on things, and where his priorities are. So, and we get all the forecasts and outlooks from present company included, as well as all the Wall Street, pundits and analysts. So that's why the January barometer works and why it's important. But the real key, even though we had Santa Claus down, it's when all three are up, it's pretty impressive. It's we get the first 5 days, Santa Claus and the January barometer up 90% of the time, 90.6% of the time, the S&P's up. And it's not a small data set. It's 32 years, 29 to 32. Average gain is pretty strong. But January alone is what really matters, and that's what the previous slide was trying to tell you. So even though we had Santa Claus down, the first 5 days are up. What's that algo telling you? The 3-day algo for the S&P. You had 3 days before, 3 days after? Is that what it is? You're on mute.
I was listening so close, Jeffrey, taking notes and stuff, but I forgot I was also talking today. But the bottom line is the 3-day algo is tied in to the monthly open. I use opens, and that's a little different take. But the bottom line is if it exceeds that 3-day high, then you can count on about 4 out of 5 months are going to be positive. And so when that ties in with your 5-day, if you do the probabilities on that, I think it's very strong that we will be higher. And that's what I've been telling people, that the market is, I think you got it exactly right. It's not a straight up, it's not a straight down. It's basically, you got to use your indicators on top of these and be in a position to take advantage of what's going to happen. I'm excited about it. I forgot about it. It came back to me after I pulled out my almanac about how you see that there's a real huge, I would say, buying opportunity later on in the year. And I agree with that, because you know as well as I do, market doesn't like uncertainty. And everybody knows with the election in November, there's going to be some uncertainty created from midsummer on. So that's right on. So I don't know about everybody here. How does everybody love me bringing Jeffrey on like this and giving us this take? I think it's a take that we all are to digest. And I just don't know. It's like I tell everybody else, if they'll listen, there's a lot to be learned from what's happened in the past. And I think it puts people in a position to really think out their moves, not just today, tomorrow, or next day, but next year even. So
you mentioned midsummer. I think that's really key, because what happens in the midterm year and why we look for that weakness or that opportunity in the Q2, Q3 is focus is taken away from the other, endeavors of the country, of the market. So people start looking away from the market. They look towards what's going on in politics, the mudslinging, the battles for these down ballot offices. And we've seen this president get rather involved in, congressional and other local elections. So this year there might be a nice opportunity if things start getting taken away from economics and market action, especially when the summer's around. Everyone starts doing other things like, golf course, beach, vacations, family, doing stuff with the kids, et cetera, so forth. But thank you, sir. Really got to get into that algo, that 3-day algo. I'm liking it.
I think so. And I'll be talking to him later on today too. We're talking about doing some stuff together. So we'll see how that goes. But I think that we're on track. Now, Jeffrey, you're giving everybody a special deal. What's the special deal they're getting?
We got a deal for you. I want to show you a couple other things, and the deal is I could skip forward to that, but somebody's asking about the slides in the chat. We can get people the slides. Either I'll get them to Tom. I'll go back to these. Here's the where's my deal slide? There it is. If you want to look at that, and then I can get you the slides. I'm going to go back and show you a couple other things before I get through there. So that's the special deal for the day. But the slides are available. Either email me or I'll give them to Tom, and we'll spread them out there. So I want to show you this a little January action. So here's my January almanac. You can see in the top table right here, NASDAQ's the number one. January's the number one month for NASDAQ. Pretty strong across the board. It's got a little bit weaker in recent years. But on the left side, the midterm year January's, it's also weaker. You can see NASDAQ's knocked down. January's knocked down number 5th on NASDAQ. S&P and Russell low. Dow's down there. It's interesting what happens in a midterm year. And then in this typical seasonal pattern for January, the midterm years since 1950 are the dotted line. And the solid line is just the recent 21 years. We like to compare different time frames. And this is a comparison of the midterm year to the recent time frame. But you can see, we're set up here coming into mid-month for a little bit of a pullback. Hopefully, we get a positive January barometer, which would be encouraging. But again, keep yourselves aware that there's a lot of chop going on here recent years in January. So that's what I wanted to just share there. Quick recap. Well, first of all, here's the best 3 months, November, December, January. Really behind, except for the Dow. Dow's up about 3-4% since over the 3 months. But S&P and NASDAQ not. The Russell's up, so we're seeing a bit of that rotation. After where we've been for so long, not so crazy. But again, keeping an eye on the 3 month span for it to come in bullish would be encouraging. When seasonality doesn't transpire as it normally does, even considering that January's weaker in midterm years, it's an indication that something else is going on. Last summer we had and last spring and summer the sell and May period didn't happen. The market went up right through it. So you got the market going up during a bearish period, a bullish indication. And then we had some of the reverse of that in Q4 where, the bullish season was a little weaker. So that's a little bit of a concern. It's got us just, our radar up, not necessarily, negative, but so again, one of the headwinds, the weak bull season this year, some of the tariffs and the uncertainty that Tom was just mentioning with the midterm year, some of the geopolitics. We got to see if the government numbers come in, inflation's rising or labor softening. I think the shutdown delays and the battle over the ACA subsidies is an issue. Crypto is still struggling to come back. I think that's a bit of a sentiment indicator these days, a little risk on, risk off indicator. That didn't perform well seasonally, and it's sort of struggling to find some footing here. I know some people are bullish on it, but I'm concerned about that. On the tailwind side, the boom, the 6th year of the presidency, easy Fed, steady economy, relative calm over there in the Middle East, the government spending, and the deregulation and tax cuts. So I think we get our rate cuts again starting mid-year. The economy stays stable and strong, job market as well, and we get that high single-digit, low double-digit gains for 26, and the boom continues. And I wanted to just give you, after this sort of overlook of the market, a couple of commodity trades. This is the chart that appeared in our last issue, ETF issue in December. The seasonal trade for this is not oil, the commodities. This is the sector. This is XLE, the energy stocks, Exxon, that type of stuff. You can see the seasonal trend from December through May. This is the trade. We're a little concerned with sort of the push of the administration to keep energy prices low, as we've heard, but this was the setup. And here's the XLE. I did pick this up myself. I picked up the XLE and the XES right around here in mid-December. We got some gains on that. We're kind of pleased. Looking for a little more strength there. It seems to be a trend higher. Again, we could Tom can dive into some of that at another time with his daily trading look at it. And then there's copper. A lot of people are talking about gold and silver. Tom had brought that up, but copper is another seasonal trade that and this is this is the actual commodity. You see again similar trend to energy. It sort of bottoms in late November, early December, when construction and all the sort of building is at a lull, and then rallies into the summer. And then this year, the setup was great seasonally because we got the macro push. Again, full disclosure, I own COPEX. I didn't pick up the CPER, the copper ETF. I do the ETFs mostly, but this is a great trade. I think I'm in this around 61 and change. It's up over 80. I guess off a little bit today. But that's a pretty solid trade, about 30% move there. Again, I love it when the seasonals coincide with technical and macro trends. And, you got the MACD down here. So it's all pretty clear, the trade here. Again, it's one of the sector trades out of the newsletter. So, just to run through, you guys have seen this before. You know what we do. If you want to get into it, you can, go to Stock Traders Almanac and check it out. Again, I can send these deck to people. They can see what we're doing. And I don't want to keep rambling on. I want to go back to Tom and see what else we can talk about. What else is on your mind? And if there's some questions out there.
Yeah, well, if anybody's got any questions, I made a decision listening to this. This is like a oral display of what I've been buying for all these years, Jeffrey, where it really brings me home to some of the things I've read in the past and all that. So we're going to do some more stuff together. But if anybody's got any questions, make sure that you get on, on this,
Hey,
because this is a heck of a deal. But I'll
thanks,
let Jeffrey
Joseph.
answer some questions.
See, Joseph took advantage of the offer last time. Slides link. Yeah, let me see if I can get that once I get off the call. I guess we'll follow up with the slides. I mean, I didn't put them up on a link yet. I just have it off my desktop here. I will post them out there. So let's see if anybody got something else. Been dipping into. Oh, good, another subscriber. Thanks, Gene. Yeah, we try to get in to these trades, these sector seasonal trades ahead of time. We like to get the the recommendation out there before the seasonality begins and try to get in there on a dip and see what, it depends upon how it's setting up. Where do you see increasing GDP in this evaluation? Thanks, Jim. Well, I mean, there's this major build out with data centers. There is lower interest rates. You've got small caps moving. I'm not sure where I don't see increasing GDP. I mean, you see it on the chart. Do we share the opinion? It says put the link in the chat. Okay, I don't have the link for the slides yet. It's just local on my drive.
I'm going to try to make that happen. Jeffrey, I just scanned the QR code. I'm going to see if I can't get the link and post it in the chat.
Oh, the link for the offer, or are they looking for the link for the slides?
For the offer, if you could throw the link for the offer in there, and then just when you have time, if you want to shoot me your slides via email, I'll get them out to everybody. That'd be fine.
Copy that. Yeah, if you could just give them that. You go to stocktradersalmanac.com and click on Get STA or click on Subscribe Now and put that code in there for whatever one you want there. Let me get back to there was an AI bubble question. I don't see it as a bubble. I think it's a boom. I see the valuations much more realistic than we were at the .com bubble. So to me, it really feels like a new world, with AI changing the way everyone does everything. I took my car into the body shop for some work, unfortunately, and the guy goes around and takes a couple of pictures and pops it into AI. Thanks, Jonathan, to get the quote, to get the estimate on the cost. So there it is, touching everything that you can do out there. The power requirements. Well, that's why the utilities were a great trade for us last year. I mean, we have a seasonal trade in the utilities from March to October. I think nuclear is showing us that we got some power requirements. Copper is part of that. It's going to get ahead of it. There's going to be a bit of a glut, kind of like the old fiber optic build out, but things are more efficient. We're using gasoline in our cars, goes a lot further. And so I think the power requirements are going to be big. They're already big. I mean, we had Verizon was down here in the East Coast. We're seeing some power stuff happening. It's part of where that, the person has more about the GDP growth. I think that's part of where we're getting all that growth from. There's also some concern. Somebody's asking about the probability, there's mentioning the profitability of the AI has already started. There's concerns about people losing jobs. There was a quote that I picked up from somewhere. I'm just going to throw it out there that I don't know of any technological innovation that has not produced new jobs. There's going to be a little bit of setback, with some of the existing stuff, but it's going to change things. There's going to be new jobs. I mean, there didn't used to be cybersecurity jobs. There didn't used to be programming jobs, and there's going to be new things that I'm not sure I have the the answer or the imagination to tell you what it's going to be, but there's going to be stuff that's going to surprise all of us with what AI comes up with. Let's see. New messages. People will have to upskill. Yeah, it's already happening. It's going to be interesting to see what my sons, who are both in college right now, are going to end up doing.
You know, that was a great answer, because if you think about it, there's not too many people out there trying to shoe horses anymore, blacksmiths, you know, if you think about it, you know. So uh guys, I think they love it. Jeffrey, we'll get you back and I'll be talking to you.
Mhm.
And we got to make a transition, and transition we'll go to live trading at 1:30 today. Great audience. I hope maybe Jonathan can capture some of those comments that were made that you could use in yourself, because it's a great presentation, Jeffrey. I mean, really very informative, and a way to learn. I love education about the market, history about the market. It makes you better at this game. It's a tough game, you know.
Mhm.
You got to
It
work.
is. And we're going to make mistakes, and we're not going to be perfect, and stuff's
No.
not going to work 100% of the time. Yeah, I look forward to talking with you later today. Appreciate you having me, and everyone's, feedback and comments, and some great questions. So look forward to doing it again and doing more with the commodities.
Deborah, if you have any problem, just send Jonathan an email and he'll make sure it happens for you.
Okay.
We'll get it done. No, I'm talking about Deborah here wanted to buy your 2-year, and
You just
the
got to
link.
click. You got to click on subscribe now, and then click on 2-year and put the code in.
Yeah, to get the discount.
Yeah.
All right, guys. See everybody on the flip side. Thank you very much. And so I think if you want to hang around, Jonathan, are you gonna play the roadmap presentation for people?
Yeah, we can do that, certainly.
All right, we're gonna turn it over to you. Play it. Y'all listen up. See you, Jeff.
Take it easy, guys. Thank you. Have a great weekend.
Yeah, so let's see. Hey, Peg and Deborah and Laura, might be having an issue with this. I'm going to show my screen real quick. I'm going to go to stocktradersalmanac.com, the link that Jeffrey gave us, and right down here, I'll circle it, is the 2-year. See that save, and it gives a price, but Jeffrey's offering an even more discounted price to us today. So if you click on subscribe now under the 2-year, you can then put the discount from today right there, and the discount is, let's see, let me post it again, 2-year 26 DTI. So make sure it's, maybe take the link from or refer to the chat here, and make sure you're typing in all caps where it's supposed to be caps, and lowercase when it's supposed to be lowercase. All right. And that should fix you up. Just as a reminder, while we dig up a roadmap video to play, today's recording and the past session we had with Jeffrey Hirsch, I think it was near the end of December. They're both on the YouTube channel. Go to dtitwitter.com/YouTube. That's dtitwitter.com/YouTube. And it was just a pleasure to have Mr. Hirsch on both days. There was so much in today's session that I know everybody's gonna have to go review it. All right. Jeffrey wanted to cover a ton of knowledge and information that no one could take in just one sitting, I don't think. So make sure you go to dtitwitter.com/YouTube. When you get there, click on the live tab and you'll see the session from today. In fact, let me go ahead and stop my screen share so I can cut today's session over on YouTube off.